Welcome to the Cashflow Academy podcast. I'm your host, Andy Tanner. This is where we make investing simple. I'm joined by my two good friends, Corey Halliday and Noah Davidson. Gentlemen, how we doing?
I'm awesome.
We haven't done introductions for a while. Before we do that, let's like, subscribe, and go to yourinvestingclass.com. Always something interesting there and always free at yourinvestingclass.com. Quick introduction. We didn't introduce our panel, so let's do that quickly for new listeners or new watchers.
Yeah. Should I go first?
Yeah, go ahead.
All right. Corey Halliday. I got started in the markets a few decades ago, I guess, about 25 years ago. And I've been trading, investing, worked formerly as a Series 4 option principal for a New York-based firm. Did that for a number of years and retired 13 or so years ago from that. And have been trading and investing and educating since. So love it.
Awesome stuff. Noah.
Hi, I'm Noah Davidson. I placed my first trade on a dial-up modem. I've been at this for a long time. I'm a reformed trader, well, semi-reformed trader, not really.
You're
okay,
recovering,
I'm an addict.
Recovering. You're recovering.
You always admit that up front. That I'm working on that investor temperament because I started out in the markets trading, trying to get rich quick, had some good times, had some bad times, and learned some valuable skills along the way. But then I also learned the value of long-term perspective and investing in Zen and those types of things. So that's my journey, and I'm excited to be here. And I've taught thousands, I don't even know how many people, tens of thousands of people how to trade and invest. Taught people how to swing trade, position trade, options, stocks, futures, forex. I mean, I've done it all.
Awesome.
So I'm an educator.
Fantastic stuff.
When you say you started on a dial-up modem, I'm expecting to hear that dang.
Yeah. All the noise.
Although the younger people won't even know what we're talking about.
I saw the coolest thing
You old.
on, they have these reels now, that have some type of dopamine effect because you get a flash of something and then a flash, it's like dopamine heaven for people. Anyway, I saw one, someone was defragmenting a hard drive.
Remember defragging?
And it just felt so good, like you were cleaning out your garage.
Wouldn't it be nice if you could do that
everything's
to
in
your
a
brain?
row now. Yeah. Everything's in a row.
Oh, that's a good visual.
I need to defrag my whole
Although
body.
that took hours and hours. And
hilarious,
hours.
right? Yeah. Defragging the hard drive.
drive.
Anyway, today's topic is a great one because I'm a little selfish here because we're going to talk about the Dow Jones Industrial Average. Couple of stocks being pulled out of that, a couple of companies being put in that, one of which is one of my favorites that I own. So it'll be interesting to hear. I'm going to give you my theory.
Dow theory?
Yeah, Dow, exactly.
There is a Dow theory.
The problem is Dow Chemical is being removed from the Dow. So when we say Dow, it's going to be a little bit weird. Are we talking about the index? Are we talking about the company? We could be talking about either in this discussion. How in the world does Sherwin-Williams, who probably buys their chemicals from Dow, get bigger than, big enough to replace Dow? Dow's a behemoth, dude.
Yeah, that's a weird switch. They also replaced
Intel.
Intel with NVIDIA, and that one you can understand that NVIDIA's certainly surpassed Intel long ago for semiconductor chip supremacy. But yeah, Sherwin-Williams replacing Dow Chemical is weird.
So here's an interesting, technically Dow Chemical has lost some ground. So I bought it at, it's really an interesting discussion. I bought Dow for the first time back in August of 2020. After COVID had dropped it and it started fighting its way back up. I think it got down into the low 30s.
Like 38, 39, something.
Was it high 30s? Something like that. I bought it at 43.81. I remember that. So I bought it at 43.81. It probably got up to, I want to say 70, 50. I don't care about that stuff. What's interesting is I've probably owned it for 4.3 years now, and I think I owe $1 on it now.
Yeah.
I think I have $1 left. Maybe less, probably less than that. I think it's $1.41. They got a 70-cent dividend coming out. That'll cut that down to about,
So you've basically paid off your mortgage, essentially. What you paid for Dow.
Exactly. So I'm not going to sell Dow at all because now I own it for free.
Yeah.
Right. Basically, I mean it's
different. But paid off the mortgage with rental income. Right?
Exactly. It's no different.
Works.
It's not, and we've done this with you and I did with Kraft. This is what we do.
Yeah.
But so I'm not going to sell it no matter how far down it goes, because I don't think the dividend is in trouble. They paid a 70-cent
you'll
dividend
keep getting
forever.
the dividend, and you'll keep getting the income.
I'll still write calls on it, and off we go, and we've compounded. What I want to know is, we just did a podcast where I said I didn't want to buy anything. Well, it's almost back down to where I bought it before.
Yeah.
It's almost there. It's like 45, I think, or something. And part of that is people will buy indexes. So when you buy the Dow, you're buying all these companies. And so now that it's out of there.
That's the Dow Jones Industrial Average.
Yeah,
right?
So I would expect Dow Chemical to fall. Here's my question for you guys. So I don't remember if you bought this too, Noah. I know Corey and I bought it. We bought Kraft Heinz on the impairment costs, where basically the story of this is Warren Buffett helped facilitate the merger between Heinz and Kraft. It became Kraft Heinz. And his cost was probably around 70 to buy it, if I recall, 70. Well, one of the things they did is they priced what they felt the brand value was for some of these brands. And one of the ones they did was Oscar Mayer. They said, hey, what is it worth just to say we're Oscar Mayer, right? How much trust is that? There's no real way to measure that. That's an opinion.
Yeah.
So what happens is when you do the merger, you say, this is how much we think that brand is worth, and they put it in their asset column as saying this brand is worth X amount. Well, if over the course of time that proves to be incorrect, the SEC requires you to do some audits and some accounting, say, you know what, we probably overvalued that, and the SEC will make you adjust that in what we call an impairment cost.
Yeah.
What's interesting is, guess where that money goes? They show as an expense. So it actually was entirely a balance sheet issue the whole way.
Yeah.
You're saying, hey, this is worth this, and then we find it wasn't. But since you labeled it as that much as part of the acquisition, if it falls and you're going to change it, how do you get rid of the money? Got to send it out through the expense column, right? So here they have this expense that wasn't an ongoing
it's not something that's going to keep.
It's a temporary thing.
Yeah.
And it affects the sale of hot dogs and ketchup or either French fries.
Zero. Yeah.
It affects that stuff zero. So here we have the stock collapse to the 30s, and we're looking at each other like, Buffett paid 70. He still likes it at 70.
Yeah.
He's not selling it. We're selling puts right now to get this put to us at 28. If we can get it that low, right? And finally it dipped down a little bit, and I can't remember what our cost basis was, but it was good, and it's paid for. Right? Paid for a long time ago. So through dividends and option writing, that thing paid for itself. So here's my dilemma. I don't like where the Schiller is. I'm paying $38 for $1 earnings. But Dow's $45.
Yeah.
And it pays a 70-cent dividend. I mean, I don't know what that is, but if this got down to 40, I mean, $2.80 a year, right? Divided by $40 is that 7%?
7%, yeah.
So you're starting with 7%, and then write your calls. You got to, in my opinion, you got a double digit again. So here's the question: as a business, I don't think selling chemicals has anything to do with whether you're listed in an index or not. I'm tempted. I don't want to buy any stocks right now, but I'm tempted to do it again, and to load up on a little, not load up, but to
buy some more,
some more of that.
And what you're talking about is a supply demand problem of the stock,
not the business.
Yeah.
Yes.
And that's what we saw with Kraft Heinz, is we said this affects the business zero. And when they first said that our brand is worth that amount, that's what they thought it was. It's not like it was fraud what they were doing. And frankly, it may have been, but now people will buy Kirkland brands, right?
Yeah.
Instead of they're not beholden. It used to be you probably had to buy an Oscar Mayer because you trusted that brand.
Yeah.
Well, now there's a lot of other brands. And so they had to take a write down. Dow Chemical getting kicked out of the Dow Jones Industrial Average doesn't change their business at all, but it changes the supply and demand of the stock. And what it does is it pushes a lot of supply, a huge amount of selling pressure onto that stock that one would say is not repeatable. It's just getting kicked out. So everyone that owns a Dow ETF, if you're iShares, if you're State Street, all of these Dow ETFs have to go sell their Dow shares because it's not one of the 30 stocks anymore.
So if you're a price guy, you got to be ready for a hit. But here's the thing. I don't care. I mean, if I have my uncle come to me and say, hey, in 5 years, I'm going to give you this stock under the conditions that you don't sell it, but you can keep all the money it makes in dividends and premiums. That's basically what I did with Dow in 4 years. So, I mean, if I can do it again at the same price, same dividend I think is pretty safe.
Yeah.
Business hasn't changed. I can do it again.
And the reason the Dow, when there's changes in those 30 stocks of the Dow, it has a bigger impact on the stock than when there's shifts in other indexes. And here's why. If a company is a mid cap and it gets moved to large cap, all of the mid cap ETFs have to sell it, but all of the large cap ETFs have to buy it. So there's a certain trade-off. One's trading to the other, and there's not a huge supply hit, right? If something gets downgraded from the S&P 500, well, then it goes back to the mid-cap index and so forth. So there's a trade-off.
Yeah.
The Dow is not that way. The Dow is just its own index. It's big. It's been around for forever. But when you're kicked out of the Dow, it's not like you're going somewhere else. You're already in the S&P 500. It's just you're getting kicked out of all of those ETFs. So the supply and demand when there's an announcement of a Dow 30 change is much different than all those other indexes where usually there's relatively equal number of buyers and sellers between the indexes. That's just not the way with the Dow. So you're exactly right that this is a temporary big time hit to the stock.
But I don't care. But I don't even care. I mean,
namaste.
It's probably not gonna recover anytime soon. But what the mentality I have is, buying it at 60 is hard to pay for itself at that 7% dividend and at doing some call writing.
Well, at
you
60,
give it to me
it's
at
not 7%, right?
But exactly. But you give it to me at 40, I'm paying that off again because those are healthy dividends. And to me, those are the types of opportunities I think that an investor looks to have. It feels very much like the Kraft Heinz to me. And Kraft Heinz has gone, frankly, nowhere since we bought it. It's still in the 30s. It's gone. Poked its head up in the 40s.
But it doesn't need to,
because
when you're generating 10, 15% just on the income side.
If you are, we're not the Capital Gain Academy. We're the Cashflow Academy.
Yep.
And when you can understand that when Buffett buys Dairy Queen, and there's no price on Dairy Queen, he has to get his money back by earning it.
Yep.
He has to get his money back by earnings and by distributions. And in our world, that'd be dividends. That's how he's got to make the money. And when you eliminate the price of Fruit of Loom underwear and See's candies, you just say, hey, how fast can this investment pay for itself? Because I'd prefer never to sell it anyway. I'd prefer never to harvest any upside anyway. So people, Andy, aren't you upset that you didn't sell at 70? No, because I have those shares for generations now. And it's a lot like land. There's a limited amount of land. Never sell your land. I'm so mad at my ancestors.
Yeah.
I looked up on the family search or whatever the heck it is, and I found how much land my great-great-great-grandpa owned in the valley where I live now. It's unbelievable. I mean, it's like State Street up into Mill Creek. It's a massive amount. What today would be hundreds and hundreds, if not $1 billion.
Yeah, hundreds of millions.
Just a huge amounts of land. Sold it all. If you get a piece of land, don't sell it because you can't. There's a limited amount. Okay, look. If you get a share of the economy, you get a share of the GDP. Don't give that up. Don't give that up.
Yep.
So I don't want to sell those shares because of a freaking price. That belongs to the Tanner family now. It belongs to our trust.
Yep.
That's ours now. We're not giving that back.
And that's the right mentality to have.
I'm telling you, man. So I'm struggling to find stocks to buy, but Dow treated me really well in a dividend. We paid it off in 4.4 4 years is what it'll be.
Yeah.
That's 20%.
Yeah.
You guys are smart. I really enjoy hanging out with you guys.
I'm not smart.
No, because
I'm not smart.
Well, that's like the only stock out there that's really caught my interest lately, just because it's on sale. It's down, and I don't think it's at the bottom yet.
By the way, on our bullish shirts that we use and train, it's been on there for 4 years.
Yeah, and
it's been a bargain for 4 years.
So, I mean, and as far as like risk out there, considering buying tech stocks that are high flyers at all time highs, they may continue to fly, but they're not paying the dividends. They're not giving you. That's not the business asset. There's again, I don't mind capital gains. I know you guys say we're the Cashflow Academy. I am not opposed to capital gains.
Yeah,
it's true, but
and I own some of those. I mean, and you can still cash flow them. They won't give you the dividend side, but it's funny. We talk
those
about
are going to have higher premiums anyway.
Yeah, but we talk about like some of these where the stock hasn't moved a whole lot and we've done good returns, more often maybe than some of the others that have had a big capital gain increase. But the reality is you're looking to pay the old adage of, I want to buy something that's worth $1 and pay 75 cents for it type of thing. And so the market will give you opportunities. There's just not very many opportunities right now. There's not pitches to swing at. We're standing in the batter's box looking. But
if you're a trader, do you buy Sherwin Williams? Because it's going to benefit from having more.
Well,
I'm not going to tie up my capital. I'm going to build some sort of debit spread or bullish diagonal type thing where I don't tie up a ton of capital, but I can still take advantage of the upside.
If it happens.
Yeah. And I wouldn't, you'd have to be quick to act to catch that arbitrage.
It's probably happened.
Yeah, but usually what happens is kind of the situation of when something is kicked out of the Dow and when something else is added, there's usually a good sized gap. There's a big shift
a little bit
that takes place. And I mean, Dow is probably down. I don't know what it's down in the last couple of weeks, but it's probably from 50s to 45 or something.
So it's down quite a bit.
And that's that Dow pressure. So the trader says, okay, it's going to be hit temporary, but it's temporary, right?
Yeah.
Because these ETFs, they'll adjust within the first few weeks. So it's not something like if you're not pretty quick to act, you're not going to catch it, but you got to act within those first couple of days of the announcement, I think.
Let's talk about this now. Intel has had its problems as a business.
Yeah.
And Intel's problem has been being able to compete with other chip makers, frankly. I mean, this is pretty cool. You're taking a chip maker for a chip maker, essentially.
Yeah.
But Intel's still Intel. I mean, does Intel have a big enough moat that they might not be the biggest castle? But as we look at Intel's already down.
Yeah.
And I don't have any Intel right now, but I'm going to go do a fundamental analysis on it and see.
I own 100 shares that I bought recently, and that's it. I mean, I got a tiny position.
How much? What's the price on it?
I bought it a little higher than it is right now. I think it's at 26 right now, and I paid 29, I think, or something like that. So I mean, it's a tiny position, and I'm just not even in a hurry. There are some decent premiums. I sold, so I've got a 26 strike call. The stock was at 23 or so, 24, and I still got like 40 or 50 cents for that. So they're decent premiums, very liquid options, very bid-ask spreads or tight bid-ask spreads. So, but Intel, I mean, it's going to be very similar to KHC and Dow. Yeah. It's not. I just don't think there's a ton of upside. But I don't think that there's a ton of downside either. So it's going to be kind of a boring one, a little bit. But they slashed it.
They've got some chips money to work with.
Well, it's good and bad. I mean,
government,
when you slash the dividend, that means you're going to have more money. But why are they slashing the dividend?
And that's always a red flag.
Why?
Yeah.
So I'm less excited.
Yeah, I'm not excited about Intel. I've got a tiny position, but the dogs of the Dow theory is...
Explain what that is, dogs of the Dow.
Yeah, so there's 30 Dow stocks, and you basically take the worst performers from the prior year tend to have the biggest dividend yield. And so there's a couple of ways you can do it. Most of the time they look at the biggest dividend yielders. But if you take the worst performers a lot of times they fall into that basket. This year, there's two stocks that really come to mind, Nike and Boeing. Those are two Dow 30 stocks that have been hammered.
Yeah.
I think Boeing is down from 300 something a share to 140.
I like Boeing because they're Boeing and the government contracts, and I like Boeing a lot.
Yeah, there's only two big plane makers in the world. There's, I think it's Embraer or whatever it is, and Boeing, Airbus and Boeing. Yeah. So those two, I mean, are it, and Boeing is the U.S. Now, of course, everybody looks at, well, they've had all these flaws and issues,
but that's what makes the price attractive.
That's what makes the price attractive.
So the way I see it is they've just had bad management.
Oh yeah, and they just got the new CEO. Usually, when a new guy comes in, it's not immediately the time because they're going to want to clear the deck, and so they
suffer a little.
Yeah, that what they basically do is they get all the junk out there. They basically write down the earnings, write down all of that stuff, give themselves a low hurdle so that now when they're taking over, all of a sudden they can start to show. Yeah, so they're like their guidance, they'll bring it down. The stock usually gets hammered a little bit because you're in this turnaround story. But it's interesting. Now, the problem is the seasonality. We're getting towards the end of the year. Because it's been so bad, it'll often be under pressure through the end of the year because people want to sell it, use that loss against other things they have gains for, and so on. So it's usually kind of pressed down still through year end. But then when the calendar hits over, or once people's 30-day wash sale rule washes out, they'll be inclined to rebuy those shares. So it may be a little bit heavy into the end of the year possibly, but it's interesting.
I like Boeing, and even Sherwin-Williams. I think there's so much you can learn from Buffett. And when you stop looking at things as stocks and start looking at things as businesses, and you just think about a brand like Sherwin-Williams, and you think about, what they sell and the lack of innovation available in that. I mean, when you look at it, like you can have a cola war in the 80s with Coke and Pepsi.
Yeah.
But it's just there's not a lot of innovation to be had in Coca-Cola. They're going to come up with Dasani water. They're actually going to sell the water, and they'll continue to expand. But their core deal, there's just not a lot of room for innovation, and no one's going to come in and take that. Well, you got your paint, and maybe there's innovation in there. I don't know, but we've been painting houses for a long, long time here. Just to own a company like that, if you just think of it, that's where the appeal for me starts. It's like the Cashflow Jack in the Box. The handle represents the work.
Yeah.
What work do they do, and do people want and find value in that work? And if you just, I'd be a proud owner of this. You picture a gala, and a limousine pulls up, and some rich dude gets out, and they go, "Oh, what does he do for a living?" Oh, he's a Sherwin-Williams. He owns that business. Oh, okay.
Oh, the Williams family, of course.
Yeah, Sherwin, man. Is that Sherwin himself? So
Sherwin the fifth.
Yeah, exactly. So owning companies, when we're in an environment of stocks at all-time highs, when you can find a dip somewhere in there and find value, I mean, 7% dividend is tough to pass up, I think. I mean, unless the company is floundering and in trouble.
Right.
So I don't like Intel. I don't like Nike as much, but I like Boeing a lot because there's just not a lot of people.
Yeah,
how do you replace? It's like Buffett's. Sorry to cut you off.
No.
It's like Buffett when he was talking about Burlington Northern Santa Fe.
Yeah.
He said it would take, what did he say, like $500 billion to build this thing from scratch.
Yeah.
To rebuild
the
this
replacement
railroad.
cost. So no other business is going to come in and build rail.
They're the biggest one. Union Pacific is a distant second.
Yeah.
They're just you got a moat.
You do. Yeah.
So when I look at Boeing, who else is going to say, yeah, we're going to start manufacturing airplanes? I mean, maybe Elon starts a company. I don't know, but it seems like it's tougher to start an airline company than a shoe company to me.
For sure. And I think the consumer is kind of proven. The reason Nike would scare me a little bit more is it's the same thing with Kraft Heinz. Maybe brands aren't quite what they used to be. When we grew up, it's like you had to have the Nikes that so-and-so wore. I don't know if that's kind of losing some appeal. I'm sure there's still that where kids want this or that, but it's almost more based off of the person than maybe the company as much.
Now this is how you get into weeds and stuff, but you look at the some brands like Nike or like Budweiser or real oil brands, they can have social risk now.
Yeah.
I mean, isn't that interesting? Like Budweiser got involved in politics, got involved in social stuff. Man, they got hit right in the face.
Then you got Kid Rock out there shooting his Bud Light with guns or something.
Well, they haven't really recovered as far as where they are in rank order of consumption.
Ran into that problem. Yeah. So, for me, if I were a business owner, man, I'd just say, look, we make great paint. Pick whatever color you want.
Yeah.
But we make great paint.
Try to avoid too much politics.
You have a lot of that now.
Oh, yeah.
Isn't that an interesting risk?
Well, Disney
got hit with that.
Political stuff.
Yeah.
South Park made a whole episode about it.
Yeah. I haven't seen that one.
I haven't seen it.
Oh, no. The stock keeps falling. It keeps falling.
Oh, geez. So all kinds of risks. I like Boeing.
Yeah.
You like? We'll have to do a fundamental analysis. It's pricey. It's $200.
I'm on the fence about the investment.
No, it's like $140 something per share.
Yeah, no, it's down. I'm on the fence about the shares. I've got some cash set aside. I'm sitting on it, but I've got long calls on it. I've got some long calls through next April.
I'm going to sell puts to buy it.
Yeah, and my experience with anything like this, where it's a dogs of the Dow type of play, because there's two real investment ideas, concepts, and I do a little of both. One is you find the value, right? You look for the bargain. That's where Boeing is. It's been tossed aside. It's been hit with massive pressure. It's got its company problems, but you anticipate that there's value in that. The other approach is, hey, this might not be the best price, but it's a wonderful business, right? And
that's where I think.
And so there's two different, processes. Boeing, you can question some of their business decision making, right? But it might be a better price. On the flip side, you got some businesses that are incredible. The problem with this side, the growth side really, is all of these wonderful businesses aren't even paying, they're not at a fair price, right? So all of the truly wonderful businesses like an NVIDIA that's growing like a weed, well, it's not at a decent price. It's at an extreme price, right? Yeah. So you're buying a wonderful business, but you're paying an extreme price. And so then you're like, I can still find some opportunities over in this bin, but I can't find anything over here. Like I have Dell. Michael Dell's been selling some shares. Dell's probably gone up, I don't know, 5 times from what I bought it at. Like it's up hundreds of %, right? I'm not selling it, but do I want to keep buying more of it? Man, it not only has it gone up a ton, I look at the valuation and so on, and it's just an entirely different situation than where it was back when I first bought it.
What's Boeing's dividend?
Yeah, Boeing, it's we could look it up, but there's
no way it's
at
8 point. No, there's no way. No, that's 2014. I was going to say this isn't giving me the.
They may have been in the same boat where they may have.
If they reduced their dividend,
they might have reduced it a bit.
I don't know that. They're not paying one.
Yeah.
So the way that I don't like that at all. So, but the way I would look at it is, and tell me if it's just simplistic. I mean, the way I look at Dow, the company, not the index, I say, look, what's it paying on a dividend? How solid do I think that is? It's been paying one out for, I want to say, 29 years without changing it, something like that.
Yeah, so they slashed the dividend back in COVID and haven't reinstituted it.
So that does put a damper on, because the way tell me if this is too simplistic. I say, what kind of calls can I write? What kind of div can I get? How long before I pay it off doing that?
Yeah.
And if it's better than a lot of what I got, I'm attracted.
Yeah, and you're only going to get the cash flow you generate from option writing. Yeah. There is no dividend.
Fat,
yeah.
If it's fat, we'll see what it is. Dogs of the Dow, huh?
It's a fun theory.
Yeah. And it's not a momentum play at all. It's more of the trying to find something that's better value.
Trying to find something that's probably got a moat.
Yep.
But at a good price.
Yep.
At a good price. So interesting discussions, man. Interesting stuff. Any final thoughts on where we're at in terms of Dow stuff? Do you buy the
the stock or the index, or what are we talking about again?
What do they call it, the diamonds?
Or the theory? Yeah.
No, you buy the
DIA.
Do you buy the
the
diamonds?
ETF.
Is there any premium on those? Not much.
I think the premiums are pretty efficient on that.
The problem with the Dow is it's sort of outdated in terms of how it was constructed and all of that. So it's 30 stocks, which is not a great representation of the global market, the U.S. market. It's just too narrow, right? And then you look at how it's constructed. Most ETFs now are market weight averaged, right? So Apple, NVIDIA, Microsoft, they're the biggest companies, so they have the biggest weighting. The Dow is price weighted, which is very strange. So if your share price is high, you'll have a bigger weighting in the Dow. If you have a lower share price, you have a lower weighting, which, I guess there could be good and bad from that. I like the aspect of, well, a lot of stocks get to higher prices because their business is flourishing, and a lot of stocks get to lower prices because their business is floundering, but market cap would be the same thing, right? It's like your market cap would grow as you're doing well as a business, and it would drop as you're doing poorly. So I don't know. It's just kind of a weird index, the way it's constructed and whatnot.
I love the inverse ETF of the DIA.
Oh yeah,
dog.
That's just a great way to be short. The dog.
Yep.
It's a dog.
It's a losing asset. Like
it's a bone, you silly dog.
So you got the diamond to play the upside, and then you got the dog if you want to play the downside. Yeah,
it's fantastic.
There's also the old Dow theory. The old Dow theory is
Charles Dow, Dow Jones and Associates.
It's a technical theory that's basically the transports should confirm the Dow Jones Industrial Average move. So if the Dow Jones Industrial Average makes a new high, but the transports don't make a new high within a certain time period, then the market's in trouble. But if the Dow makes a new high and the transports also make a new high within that next month or two, I don't remember the theory exactly, then you got a good sustainable bull
you're creating
market.
Stuff and moving
there's also Dow
creating and moving.
Yeah.
There's also Dow price theory, which is what goes up must come down. If it goes up 10, it comes down 5. It's just it's like a rudimentary Elliott wave. Like if it goes up this much, it pulls down this much. Yeah, it's like
Fibonacci retracement or something.
Yeah. So interesting stuff.
Fun, great conversations today. This is my favorite day of the week. I am so appreciative to be at this table with you guys and your experience, and I learned so much. And it's
like I said, you guys are smart. It's nice being the dumbest guy in the room.
Not hardly
because you're not in the right room if you're not.
Oh, geez, here we go. He can't sell this here. We're not buying that.
Nope.
We're not selling this here. Great stuff. You've been watching and listening to the Cashflow Academy podcast. This is where we do our best to make things simple. Drop by yourinvestingclass.com, hit the like and subscribe if you find value in the conversations that we have, and we'll see you next time.